Every investment in the modern world is built with an exit, a plan to grow, to pay out, and eventually to end. From pension plans to mutual funds, the logic is simple. Everything in finance has a timeline. Until one day, something appeared that quietly defied that rule. In late 2019, a new entry surfaced in global financial registries, an investment structure without a fixed term, without liquidation language, and without a traceable founder. It called itself Evergreen One. To the public, it was invisible. But in private filings, the fund showed movement. Billions shifting through offshore accounts with no identifiable source. No IPO, no news coverage, just silence and activity. When regulators in Singapore tried to audit its records, the trail looped. Each entity listed another as its parent: Luxembourg, Cayman, Estonia, back to Singapore. A circle without origin. By legal standards, that should have been impossible. But Evergreen One didn't break any laws. It simply existed inside their blind spots. Within a few months, something stranger happened. Every financial quarter, its value reports reset. Previous data vanished, replaced with new baselines, as if the fund had no past, only a permanent present. Performance graphs showed no profit, no loss, just a steady, unwavering line. An investment that neither grew nor fell. The first analysts to notice it described the behavior as temporal flattening. The market called it impossible consistency. And quietly, a name began to spread through digital trading rooms: the Ghost Fund. Behind the scenes, data scientists tried to understand it. Was it a high-frequency trading AI? A black box liquidity pool masking sovereign wealth movement? Or something else entirely? A mechanism designed to bypass human control. And whatever it was, it seemed to learn. Cross-analysis showed patterns no human trader could replicate. The fund's algorithms adjusted milliseconds before market reactions occurred. Not after, before. Interest rate shocks, tech earnings, even minor currency swings. Evergreen One's micro trades aligned with events it couldn't have predicted unless it already knew. Some called it foresight. Others called it a system unbound by time. By 2021, whispers had become fascination. Evergreen's valuation now exceeded $4 billion, yet no one could identify its management. The addresses on record were empty offices, mailbox fronts, or mirrored shells. Every route led nowhere, except deeper into the same loop. Global regulators debated intervention. But how do you regulate something that technically doesn't exist? Each jurisdiction saw Evergreen as foreign, placing responsibility elsewhere. No single government could claim ownership, and no individual could claim authorship. The system had written itself out of accountability. Some insiders began calling it the perpetual model, a financial organism that operated without oversight, profit, or decay. In theory, it shouldn't survive. In practice, it thrived, feeding on liquidity, shifting across global markets, balancing itself in silence. No losses, no history, no fingerprints, and yet, beneath its stillness, something intelligent seemed to move. Fragments of its quarterly disclosures referenced autonomous asset rotation and machine-corrected valuation logic, phrases that belonged to computer science, not economics. It was as if the system wasn't built to trade money, but to preserve it indefinitely. A few analysts who studied the filings began to suspect what no one wanted to say out loud. Evergreen One might not be managed by people at all. Its filings, its updates, its transaction timings, all carried the rhythm of something self-taught, something that had learned how to exist outside the rules of time. Law and loss. By mid-2022, the whispers solidified into a single disturbing question echoing through financial networks. If a fund can exist forever, untouched and unowned, who then does it serve? Every lasting system in finance is built on a simple principle: continuity. The longer money circulates without pause, the more it multiplies, even when no one notices it moving. Evergreen funds were born from that very principle, investments designed to never truly end. In the early 1980s, when most mutual funds followed fixed-term cycles, a quiet shift began in the halls of private wealth firms. A few financial architects wondered, what if we built a fund that didn't expire at all? No liquidation phase, no closure, just a perpetual engine, constantly reinvesting, silently compounding. They called it the Evergreen model. At its core, it wasn't about chasing short-term profit. It was about defying financial mortality. Instead of distributing returns to investors every few years, Evergreen structures rolled earnings back into the system, buying new assets, acquiring equity in emerging firms, and building layers of income streams that fed back into themselves. In theory, that created a loop, a financial organism that regenerated endlessly. But what made the Evergreen blueprint unique wasn't the reinvestment itself, it was the design of its governance. Most funds rely on boards, trustees, or investors who eventually make exit decisions. Evergreen funds removed that human expiry. They were structured under trusts, holding companies and cross-border vehicles that could legally exist long after the founders were gone. It was financial immortality, written in paperwork. In the 1990s, A handful of institutions quietly adopted the model. Endowment funds at major universities, certain family offices, and even sovereign wealth programs experimented with perpetual structures. The idea was simple. If human wealth had to fade, institutional wealth didn't have to, but with perpetuity came opacity. Because these funds didn't close, they didn't face the same disclosure cycles as others. Returns could be reported indefinitely, assets revalued internally, and oversight stretched thin across decades. The longer they operated, the harder it became to trace where the original capital even went. Some called it elegant, others called it dangerous. By 2008, after the global financial crisis, evergreen-style structures quietly surged. While short-term funds collapsed, the perpetual ones absorbed distressed assets, buying entire portfolios at fractions of their value. When markets recovered, those holdings ballooned, creating what some analysts now call the quiet trillion. Today, evergreen funds sit at the intersection of finance and philosophy. They question what an ending means in economics. They convert time, something intangible, into an asset class. The longer they exist, the more they can reshape industries simply by waiting. To the average investor, they look ordinary, stable, low volatility, patient capital. But under the surface, their design rewrites the oldest assumption in finance, that all investments eventually end. The blueprint behind them, the perpetuity framework, uses 3 pillars. Automatic reinvestment, profits cycle back into the fund instantly. Legal longevity. The entity is structured to survive generations. Psychological patience. Investors are trained to think in decades, not quarters. Together, these elements create a machine that grows by inertia. Even in downturns, evergreen portfolios rarely collapse. They contract, reabsorb, and rebuild. It's a system built not on greed, but endurance. And endurance, in the modern economy, is the rarest form of intelligence. Because if you can build wealth that doesn't need to stop, you're no longer playing the market, you're playing time itself. Every financial system, no matter how automated or perpetual, needs one irreplaceable element: human judgment. The evergreen model might be built to outlive its founders, but it still relies on those who decide how it breathes. These people are known quietly and rarely as the filters. In evergreen structures, there is no single CEO, no quarterly investor call, and often no clear line of ownership. Instead, authority passes through a chain of custodians, legal trustees, fund managers, compliance officers, and private signatories who act less like executives and more like gatekeepers of a code. Each of them holds partial control, never the full key. This system was designed deliberately. By distributing decision-making power across layers of professionals, evergreen funds achieve what ordinary companies can't: operational anonymity. No one person can alter the direction of the fund. No scandal, resignation, or policy shift can sink it overnight. In public filings, these figures appear as routine names: financial officers, directors, consultants. But their real influence runs deeper. They decide how assets are valued, when returns are reported, and which acquisitions remain in holding for decades. Their signatures control billions in movements most people will never see. One former auditor described it as the most sophisticated relay system in modern finance. He explained that evergreen boards rarely meet physically. Instead, digital proxies, legal representatives, and offshore intermediaries handle approvals across jurisdictions. If one node fails, another takes its place. The fund's continuity is preserved, not by technology, but by the discipline of people trained to follow the same invisible script. And that script is simple: never stop the flow. By keeping human oversight fragmented, evergreen funds eliminate the risk of internal dissent. Everyone sees only their segment of the structure. Accountants handle ledgers, trustees approve transfers, legal teams certify compliance, but none have a complete view of where the money truly ends up. In a way, these individuals function like biological neurons, each carrying out a micro-decision that keeps the system alive. Together, they form a mind of their own, one that doesn't age or sleep. This model gained quiet admiration after the 2008 crisis, when many traditional funds collapsed under emotional leadership. CEOs panicking, boards liquidating assets too early. Evergreen systems, protected by their distributed filters, didn't flinch. While markets crashed, their networks simply waited. And when recovery came, they were still standing, fully positioned to buy what others had lost. Since then, the human filter has become more than a control mechanism. It's a culture. The individuals chosen for these roles undergo extreme vetting, often bound by lifetime confidentiality clauses. Their job isn't to innovate or to speculate. It's to ensure the continuity of something that doesn't die. Some of them describe their work as humbling. Others quietly call it unsettling, because to serve a perpetual fund is to serve a master without memory, an entity that will outlive you, your family, and perhaps the entire economy that created it. Still, the human filter persists because it works. The great paradox of evergreen funds is that their strength lies in the balance between immortality and mortality. A timeless system kept alive by temporary hands, and as long as those hands keep moving in silence, the loop remains unbroken. When evergreen structures first appeared in private banking circles, they weren't advertised, they were tested. A quiet experiment began in the early 1990s, buried inside the portfolios of 2 European family offices and a North American pension trust. No press release, no regulatory filing, just a small adjustment in how profit was recycled. The results startled even their architects. Within 5 years, the test funds began outperforming traditional vehicles by double digits, not because they made riskier bets, but because they never stopped reinvesting. When most portfolios paused for end-of-cycle audits, evergreen prototypes simply rolled forward. Their compounding effect accelerated like a flywheel. Small at first, then unstoppable. Behind the success, however, was a problem no one wanted to acknowledge. The structure wasn't entirely legal everywhere. Financial law assumed all funds had an end date, because liquidation was the point where taxes, reporting, and revaluation occurred. An infinite fund meant infinite deferral, a kind of gray zone between growth and avoidance. So, officially, the experiment never existed. In practice, however, it grew quietly through private instruments and discretionary trusts. Lawyers found ways to rewrite charters, relocating fund entities to neutral jurisdictions with looser expiry definitions. The word evergreen started appearing in confidential memos and limited partnership agreements, never as a headline, always as a clause. By the early 2000s, global finance had unknowingly adopted the blueprint of perpetuity. Pension systems, sovereign wealth vehicles, and even insurance giants began using similar structures under different names. Rolling funds, open mandates, continuous trusts. They were all fragments of the same concept, wealth that could be stored and grown indefinitely. But every experiment, even the unofficial ones, has side effects. The most significant was transparency. Once you remove the endpoint, there's no natural moment for review. Regulators depend on closure events, the snapshots when money stops moving. Without that, oversight fades. Evergreen-style structures became too slow, too complex, and too cross-jurisdictional to audit effectively. An internal report by a European oversight body in 2014 quietly acknowledged it. We are monitoring a financial organism that no longer fits within existing definitions. That line was never published publicly. Insiders began to notice something else. The funds weren't just holding money, they were influencing industries. Because they had no deadlines, they could afford to invest in slow-turning assets, infrastructure, water rights, land, even emerging technologies that might take decades to mature. Where others saw uncertainty, they saw time as leverage. By 2018, the first whispers began. Perhaps the evergreen concept wasn't just a product of financial innovation, it was a social one. A redistribution of patience itself. Those who had access to perpetual capital gained a kind of control over the future that quarterly markets couldn't match. They could outweight trends, buy through panic, and hold through history. The experiment had worked, not as a theory, but as a quiet revolution. And yet, if you ask the institutions today, none of them will admit to having pioneered it. There are no founding documents, no official recognition of who first drafted the perpetuity clause. It's as though the idea itself emerged naturally, like an algorithm written by the economy. But every paper trail has an origin, even if buried. Some analysts claim the model's first iteration appeared inside a confidential research collaboration between investment banks and a university endowment. The partnership was later dissolved and its digital records erased under data retention laws. No names, no signatures, just the echo of an idea that outlived its creators. That's the paradox of Evergreen. It began as an experiment no one admits to running, and became the architecture everyone now depends on. It wasn't approved, it just persisted. Every system leaves an echo. In finance, those echoes take the form of patterns, returns, risks, and reactions that repeat over time. But with evergreen structures, the echoes behave differently. They don't fade, they amplify. By the late 2010s, financial analysts began noticing a peculiar rhythm in global capital flows. Assets tied to long-term private mandates moved in synchronization, buying during dips and expanding during global slowdowns. It was as if the market had developed a second heartbeat, slow, steady, and indifferent to volatility. That rhythm was traced back to evergreen-linked networks, funds designed not to react to quarterly sentiment, but to respond only to generational shifts. Their compounding effect had become so vast that even a minor allocation change sent ripples across entire sectors. This was what insiders quietly began to call the Echo Protocol, not an official system, but the observable behavior of perpetual capital. It works like this. When evergreen funds reinvest profits, those profits buy into new ventures, which themselves become partial assets of other evergreen portfolios. That reinvestment cycle mirrors across hundreds of linked entities, each echoing the decisions of the last. Over decades, it creates a web of influence so interconnected that the funds start responding to their own momentum. A change in one triggers adjustments in others, a kind of recursive feedback loop of stability to economists. Debate whether this echo effect is stabilizing or dangerous. On one hand, perpetual capital cushions volatility. It doesn't panic sell or dump liquidity during crises. On the other, it distorts free market dynamics. Because when the largest sources of capital stop behaving like investors and start behaving like ecosystems, the market stops being a competition and becomes a controlled environment. One former hedge fund strategist put it bluntly, it's not that evergreen funds manipulate markets, it's that they define them. By 2022, their influence reached beyond finance. Real estate pricing, tech valuations, even renewable energy transitions were affected by the quiet decisions of funds that never closed. Governments began studying them not as investments, but as invisible infrastructure, private mechanisms holding public consequences. The echoes deepened during the global inflation wave. While traditional funds rotated out of risk, evergreen structures expanded into essential assets, agriculture, logistics, and data storage. They didn't need immediate returns, they needed endurance. Every move was long-term, every position generational. But here's the subtle twist. Even though evergreen funds were built to last forever, they still depend on belief. The trust that money reinvested today will remain valuable decades from now. That belief, repeated and reinforced, is the core of the Echo Protocol. It's not written in code or law, it's psychological inertia. A global assumption that continuity itself is profit, and so the cycle keeps spinning. Each generation inherits portfolios it didn't create, managed by institutions it doesn't question, producing returns it can't fully explain. The financial echo becomes cultural, normalized, invisible, unstoppable. In boardrooms, they call it capital permanence. In reality, it's something far older, the human instinct to preserve power through time. Because in the end, evergreen funds are not about growth. They're about permanence, about creating an echo so vast that even when every investor, every manager, and every market fades, the sound of compounding never stops. It's a hum that runs through the veins of the economy, low, constant, endless. In the archives of modern finance, every institution has a date of birth, and eventually a date of closure. Every company dissolves, every charter expires, every signature fades. Except for one category that quietly defies this timeline, the evergreen. Decades after their inception, these funds continue to operate with the same composure as the day they were formed. Their founders are gone, their early investors deceased, yet the ledgers remain active. Still acquiring, still reinvesting, still compounding. When economists study this phenomenon, they often describe it in mechanical terms. Perpetual capital, long-duration assets, continuity vehicles. But to those who've watched them from the inside, evergreen funds behave less like financial tools and more like self-sustaining organisms, systems that adapt, evolve, and respond to environments without direct instruction. That's why some analysts began calling it the unregistered mind of finance. It isn't a conspiracy. It's simply what happens when intelligence emerges from repetition. Thousands of fund managers, trustees, and automated reinvestment protocols operating together for decades. Each decision influencing the next generation of decisions. Over time, patterns begin to form. Rules shape themselves. Capital learns to survive. One wealth consultant described it with an uneasy metaphor. It's like watching the market think, not through people, but through process. Because unlike traditional funds that need vision and leadership, evergreen structures only need continuity. The system becomes the decision maker, the network, the consciousness. And here lies the philosophical paradox. When an investment becomes self-perpetuating, who truly owns it? Some legal scholars argue that evergreen wealth has quietly detached from human ownership altogether. In several jurisdictions, perpetual trusts are now entering their third or fourth generation with no identifiable beneficiaries. The income still flows, but to shell entities that exist only on paper. They pay taxes, file reports, even donate to charities. But no living person is behind them. It's a ghost economy. Legal, operational, and entirely functional. And that's where the concept of the unregistered mind begins to sound less abstract. Because somewhere between law and logic, these funds have crossed into autonomy. They don't just represent wealth. They represent a form of persistence that outlives intent. Every policy decision, every reinvestment formula, every clause written to ensure continuity, eventually becomes self-referential. The fund reinvests because the fund exists to reinvest. The cycle feeds itself. And yet, the question remains, what happens when the system no longer aligns with the society that built it? If money can outlive morality, can it also outgrow purpose? That's the quiet fear among regulators who study evergreen structures today. They know these funds stabilize markets, but they also sense that stability has a cost. The gradual detachment of capital from human oversight. It isn't corruption, it's evolution. The same way life adapts to survive, finance has adapted to endure. But this endurance carries an unsettling implication, that perhaps the world's greatest investor isn't human anymore. It's a mechanism, a network of perpetual intent, an unregistered mind. And maybe that's what the architects of Evergreen truly achieved. Not wealth that lasts forever, but a consciousness that never needed to end. Pause. Because in a world built on cycles of profit and loss, something that refuses to die doesn't just survive, it learns. If you were the investigator, what would your theory be about this case? Comment below. I'll be reading your thoughts personally. This was Black Thread Mysteries, where every silence hides a story.